Welcome to Macro Hive Conversations with Bilal Hafiz. Macro Hive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, Jim. It's always great to have you on the podcast show.
Well, I love being here. We've been friends for such a long time. I love reading Macro Hive, and I think you guys are really building up a wonderful consulting risk advisory business. It's really fun to be part of it.
No, great. Appreciate that. Very kind words. And you've been a big supporter for us from the very, very beginning. Now, before I start the conversation, I do need to timestamp this podcast because we're doing this on a Wednesday, the 22nd, a few hours before the Fed meeting. So if we touch on the Fed meeting, we may or may not be right, but the views we'll talk about here will be kind of beyond the very short term. So just this as a timestamp as well. And also, at the moment, in terms of banks, everyone looks stable right now. So if by the time you hear this podcast, if there's a bank's gone down, then we wouldn't have known about that. So with those disclaimers, let's go into our conversation, Jim. So I guess first up, I mean, what are some of the big kind of themes that you're thinking about over the course of this year?
You know what I think is that the world has really become multipolar. And people are slowly starting to realize that. You know, we went from a unipolar world, 1990s, the US has won the battle of history, the end of history. You know, then we get the GFC and China, I think, with its very aggressive macro stimulus program makes a big difference to the world. And I think economists start saying, well, you know, maybe we're bipolar. The way China acted, that made a significant impact. And I think in the last 2 years, 3 years, we've seen more and more evidence of the world becoming multipolar, where individual countries that are large, but not as large as the US or the EC or China, are just saying, look, we are looking out for ourselves. We are not thinking about being part of the Chinese embed or the US area of influence. You know, we are Brazil and we worry about what's going on with the Brazilian economy and Brazilian unemployment and, you know, the inflation rate here and, you know, what happens in the rest of the world. Yes, it's important to us because we are large exporters, but in the big picture, what really matters to us is what happens here in Brazil or in Indonesia. So Indonesia, a couple of years ago, passed a law or regulation that they didn't want to export tin anymore. Large tin exporters. Why not? Well, you know, all the value added ended up accruing to people outside of Indonesia. You know, no factories were being built in Indonesia using tin to make final products, to train engineers. You know, mining by itself doesn't create lots of jobs. And, you know, you start seeing the same thing, the discussion in Chile about copper. Like we're the world's largest copper exporter, yet, you know, not that much of the benefits end up staying in Chile. And, you know, I think this idea of the multipolar world is really interesting in terms of macro, because now what you need to think about are idiosyncratic bets. And it helps you realize that you could have a certain bet in one of these countries. So we might say, well, I think India is going to be one of the best places to invest in the next 5 to 10 years. And, you know, here are the reasons. It's the demographics are good. The tech sector, there was a big push now to improve manufacturing. You know, manufacturing really did a better job. Your export picture would change dramatically, because part of the trade deficit in India really is driven by manufactured goods. So if you could have an impact there and start exporting handsets, for example, well, that would make a big difference. And, you know, we're starting to see this kind of rebasing of supply chains out of China into all different parts of the world. And India is clearly trying to pick up on those. So in terms of big picture thinking, that's one of the things that I've always been interested in general, because I have always thought that, you know, this world of post-colonial colonialism where nothing's really changed. We had the end of colonialism, but just kind of continued economically speaking. And the gatekeepers changed, but it really didn't change the effect in those countries. But I think now there is a real push to make a difference, and that's going to lead in the macro world to idiosyncratic bets, where things like Brazilian interest rates could drop quite dramatically, even if U.S. rates don't. Inflation rate in Brazil is down in the fives. Official central bank policy rate is 13.75%, some of the highest real rates in the world. Could they lower interest rates over the next year, even if the Fed does nothing? For sure. I mean, it's an idiosyncratic bet. So I think for people who are interested in the world, and I think macro kind of implies that you're interested in the world and you're not a narrow silo specialist. You're not really good at certain type of debt instrument or, one equity market or large caps versus small caps and thinking about long short portfolios. But you really think about what's happening in the world. What is moving the world? This is a great time for macro from that perspective.
And just to elaborate on the multipolar side, is it just the larger emerging market countries, or is it kind of much more than that? Is it India, Brazil, Indonesia, but you also mentioned Chile, which often doesn't get mentioned, within the bigger guys, so to speak. So from the sounds of things, it's quite a wide multipolar world.
Yes, I think it's not just the really large ones. I think you can see it in Czechia. Euro Czech has moved quite dramatically in the last 6 months. There's plenty of liquidity to make money in it. You just have to be focused. You just have to think about what is the central bank here trying to achieve? How are they doing it? Do they want to raise rates more or not? What other ways do they have to address inflation? Oh, the currency could be one way. You don't have to be a large country. One of the things that's happened in the last 10 years for sure is that many of these markets now have very reasonable amounts of liquidity. And you can do auctions, cash trades, even in these smaller countries, like in Euro Czech or in Euro Poland or in Chile. You have no problem finding liquidity for very reasonable amounts. So I think this idea of multipolarity does reach further down than just the kind of like second tier large countries. Although, of course, you're going to find interesting things as well. And I think a lot of people are focusing on them, but you probably get an extra edge in these somewhat smaller ones. Like, when is Europe going to finally break back down? How important are the issues on the rule of law? Discussions they're having with the EC, what politics are driving the ruling party, the PIS, to be so obstinate about judicial reform, even if it's costing them money. Lots of interesting questions to be asked on these so-called smaller countries, but they're becoming increasingly more important. And I think the Ukraine-Russian conflict has clearly shown that Poland has become much more important than it was before. And, the idea that Sweden is going to hopefully join NATO, try to join NATO, I think, again, speaks to this idea that, there's something special going on in Sweden. We should think about Sweden and what is going on in Sweden, or, what is going on in Turkey, and why is Turkey so dead set against allowing the Swedes to join? And, how is that all going to play out? So I think macro has become increasingly interesting from that multipolarity standpoint, but also in the 10 years from past GFC, basically all the central banks were doing the same thing. They were all lowering interest rates, supporting domestic economies. You basically had a high correlation. It didn't really matter in beta. It didn't matter which equity market you bought. You probably made some money. You might have done better if you bought the US one because that one performed. But in the big picture, you weren't forced into really thinking idiosyncratically. Whereas now I think you are. So that's one thing I'm thinking about. The other thing that kind of concerns me or I think about is this whole question of inflation and how permanent it is. Do we have methods to address it? When I read, I think it was a San Francisco Fed had a paper on the sources of inflation, that 50% of them were supply side driven right now, and approximately something like 1/3, 33 to 36% or so were demand side driven, and the rest was kind of ambiguous. Well, central bank policy is really not directed towards supply side inflation shocks. They address demand side. When you raise interest rates, you're not creating more supply. What you're doing is you're depressing demand in whichever way you can. And if you aren't addressing the 50% on the supply side, well, then the uncertainty about inflation looking forward, it ought to be higher than what I think markets are seeing. So when I look at inflation swaps in the US, they basically right now have dropped to 1-year inflation swaps at about 2 3/4, and everything after that is at like 2.5. But, I have a hard time seeing that the volatility of inflation is going to be as low as what the inflation swaps imply. I think that there's going to be a lot more volatility coming out of actual inflation than what markets expect. And that volatility will obviously translate into market price volatility, where if you have higher volatility of inflation, whether it's higher or lower in terms of absolute number, if inflation dropped to 1.5 rather than 2.5, or there was at 4 instead of 2.5, those things are going to have a massive impact on fixed income rates, and because of fixed income on currencies, and of course, because of fixed income rates, which drive the discount rate on equity markets, and. So, I think, again, it's a point in favor of thinking actively about macro and how it impacts portfolios in general.
And this is not confined to the US either, presumably. This is a global phenomenon in terms of the supply and demand dynamics in inflation. It's in Europe, it's in Asia.
Yeah, I think so. I think it's the same in every place. I think that commodities inflation, is it supply driven? Is it demand driven? Is it politically driven? It's not that easy to really disentangle. And I think that we are in a period of uncertainty, higher volatility, and therefore more interesting idiosyncratic markets in general. And the other thing is that, the question of inflation and fighting it via the central bank monetary policy kind of doesn't address the issue that I think has arisen for the last 40, 50 years. So 40, 50 years, labor has not participated in productivity gains. So, as if you draw a chart of productivity gains, from 1950 on till about end of 1970s, median wages kept pace with productivity. That kind of made sense. Since then, median wages have more or less gone sideways, but productivity has continued to increase, maybe not as rapidly as before, but it certainly hasn't been negative. So where have those productivity gains gone? Well, they are showing up in corporate profitability. So, we're now at the probably highest in the US corporate profit margins, which are running at 14.5%, or profits as a percent of GDP, compared to income that's going to labor. So income that went to labor 40, 50 years ago was like 58, 59% of GNI, and now it's down to 53. So workers end up 6% less wealthy as a percent of GDP allocated to the working force. And corporations make about that much more. And I think, that leads to a very big picture issue, which is that this cannot continue forever. Those kind of trends that are bounded by 100 and by 0 eventually mean revert. Like you can't have labor's income dropping 53 to 43 to 33, or corporate profits going from 10 to 15 to 20 to 30. So I think we're getting to a period of time after 40 years where there's labor strife developing and pushback to corporate power. And I think that kind of dissonance in a society over time affects markets. It will affect equity markets, however it's resolved. I personally think that what's happening in the US right now, we have an FTC under the Biden administration that's very much pushing back on corporate power that is monopolizing small parts of the economy. It's not just the big things that are becoming less and less competitive. It's not just, the defense industry in the 1950s had 50 suppliers, now they have 5. Okay, that's pretty clearly a problem. It's happening in everything from, rolling up hospital chains or assisted living facilities. The economy is becoming less and less competitive. Capitalism is about competition, but running an individual business is about trying to be less competitive. You don't want to compete with somebody else. No. You want to monopolize what you're doing, because that way you can charge the highest rents, and therefore your profitability will be the highest. So I think that is one of the big issues that markets are not really focused on. I think over the next couple of years, we will continue to see pushback. And that's my downside on equity markets. It's actually coming from the political economic side, not so much from looking at PE ratios and, margins, et cetera, but really that in the politics of the United States, we're starting to see this pushback from labor against corporate power, number one. And number two, we're starting to see a general decline in democratic indicators. And there is research, mainly from emerging markets, but in general, that declines in democratic governance tend to be correlated with less positive equity markets, or improvements in democratic governance are correlated with outperformance on equity markets versus some kind of benchmark. So those two things make me a little bit nervous about US equities. I'm not really nervous when I think about valuation. So we did a study on what's called ECY, which is the excess CAPE yield. Schiller started out with CAPE, the cyclically adjusted PE ratio, where he looks back 10 years and calculates an average PE, just so that the cycles all kind of average out. And, about a year or so ago, he started thinking that, when rates are at 0, maybe CAPE is not the correct way to think about the world. You should be thinking more about this idea of convert CAPE to a yield by inverting it, and then subtract real yield so that you have some kind of measure of equities yielding a lot more real than bonds or not. And that kind of tells you something about the valuation. And if you look at the ECY today, it's barely below the median over the last 70 years. So it's within half a standard deviation expensive. But when you then look back at well over the last 70 years when the stock market in CY was at those kind of levels. How did the stock market do over the next year? Well, 75% of the time it was up. So
on this kind of yield adjusted valuation basis, it's not giving you a strong directional signal.
Exactly. It's not saying that you're in the upper quintile of valuation or the bottom quintile where, suddenly valuation matters because you're going to have mean reversion where you're at the really high or low level. But when you're kind of in the middle, then valuation isn't going to be right. Now you have to think about valuations. Yeah.
Yeah. And then earnings, I guess, then become, so structurally, can US companies still secure such high profit margins on a 5-10 year basis? And as you say, forces looks like they're turning. Actually, a related question I had just in terms of US democracy and what's happening in the US, and I'm speaking as a European here, what seems to be happening is seems to be a decentralization, a move back towards the states in terms of power, from the federal to the state. So there seems to be more competition between the states into the different tax rates. We had changes in social policy, which suddenly has forced the states to have to intervene on social policy, for example. So, do you see that as something that's kind of a feature rather than a bug in the U.S. system? That you also have the state sort of system as well as the federal system.
It's supposed to be a feature, right? I mean, the states are called the laboratories of democracy. You're supposed to be able to try things in different states. I'm not sure it really works that well when you have the amount of gerrymandering we have. So that the political system, I think, kind of interferes with the laboratory part. It says, we're going to make sure that you know who the scientists are who are creating experiments in these laboratories. And I think there is also something about the power of different states. When California says, I want cars sold in California to have certain mileage requirements or exhaust requirements, well, that almost sets the stage for the rest of the country, because if you want to sell a car, you're not going to build 3 different kinds of cars. And California being as large as they are kind of sets the standard in a certain way in those areas, not in social policy, but in economic policy, clearly does have an inordinate amount of power.
Yeah, no, I hear you. Yeah. So I guess, the system, the gerrymandering actually, messes up the system. You kind of need to somehow not have that, and then everything works well. So, points well taken there. Yeah.
Then you can try things more easily, I think.
Yeah.
But we shall see. I mean, that's part of this push in trying to create more democracy in this country. And, there are forces that don't want more democracy. People who feel they've been hurt by democracy. People who think that, maybe we've had too many immigrants, legal or illegal, and that's not been good for the country. Different views on those questions.
Now, what we haven't talked about so far is banking crises. So obviously, for the past week or two, there's been a scare around banks. We've had 1 or 2 US banks fail, fears about other regional banks in the US. Then in Europe, we had Credit Suisse. What's your just high level, what's your general view here? I guess the first question is this a repeat of 2008 or not? And then just any additional thoughts beyond that.
So I don't think it's a repeat of 2008, number one. Number two, I think that the Fed in the last 20 years has learned to use different instruments quite aggressively. So 1998, LTCM happens, Russia has a default of internal debt, stock markets come down. The Fed didn't change the balance sheet. The Fed changed interest rates. Today, the Fed actually thinks of the balance sheet as another instrumental policy variable that can address liquidity issues, and interest rates to address inflation issues. So I think that the Fed has done a better job than they would have done before, because they've just realized that they haven't. Now, banks, I think, are in a difficult position when the Fed is raising rates, the curve flattens and eventually inverts. And when the job of a bank is, to do maturity transformation, which is they take deposits, they make mortgages, other loans to people, small businesses, medium-sized businesses. Their profitability is driven by a reasonably, historically positively shaped yield curve. So they pay less on their deposits than they're making on their loans. In the world where the Fed is aggressively raising rates to combat inflation, banks are going to have a hard time. Smart banks are going to have a less hard time because they do a good job hedging the fact that the Fed told them, in December of 2021, that we are going to be raising interest rates. I mean, Jay Powell was not trying to hide it. We just had to listen to him and say, well, I think he's serious. We don't know how much he's going to raise rates. He didn't know how much he was going to raise rates. But from that moment on, it probably would have behooved a bank to hedge some of the interest rate risk inherent in their portfolio. And if you look at the big banks, most of them did. I mean, JP Morgan stock price, it's down from the highs, but it's nothing down like the small banks or the ones that absolutely did no hedging or took off their hedges. And that part, I think, was just incompetence on the side of some of the banks. And I don't think all the banks are incompetent. I think even medium-sized and smaller banks have access to figuring out how to hedge some of the interest rate risk. If rates go high enough, depositors will flee. I mean, you have to keep raising rates, and at some point, you will still be losing money to some of the deposits to when the market falls, with the T-bills. And if rates are just high enough above what you are willing to pay depositors, you're going to have some outflows, and you just have to figure out what we can do to cover the liquidity, which does mean that we're going to have we already have tighter lending standards, but one way to address it is just to not renew loans that are running off your book. Then you have a small asset base to cover. So is it likely that over the next 6 months, 12 months, there's going to be less loan growth, more tightening of credit standards at banks? Yes. It ought to happen because, banks don't want to go bankrupt. One way to address it is to have fewer assets on your balance sheet. Don't renew the ones that mature. If you have hedged, you continue to hedge. You might sell some of your securities when you have an uptick in prices and a downtick in yields. But in general, if your securities were marketable and you had hedged them, you were perfect, you shouldn't really have a bankruptcy problem from that side of the equation. You will have a profitability problem over the next X years until the yield curve normalizes again. Will the yield curve normalize? At some point it will. At some point, inflation will come down and the Fed will ease, or we'll have a recession, the Fed will ease. And we already saw it immediately during the banking crisis that the slope of the yield curve changed quite a bit. So take the 5 years against 30-year spread of interest rates, that was at minus 50-ish basis points when the first bankruptcy started happening. And now it's at flat. It's like a minus 2 basis points. So, 5s, 30s have started to normalize. Will they continue to normalize? Well, I think it depends a little bit on what the Fed does over the next year. We'll know what they'll do today a little bit later. I personally think they'll probably go 25 because they still have plenty of inflation, but it'll be a soft 25 where they say, we're now going to stop for a while, watch the data, see what the banking system is doing, see what loan growth is doing, and we will certainly slow down any kind of aggressive moves that we may have planned before we had the banking crisis. But, the whole thing started with Powell suddenly implying that he might go 50, and that really, I think, was one of the things that led to increased volatility in markets that people just hadn't expected. I mean, it was a lot of flip-flopping around, going from, we might be stopping to 25 to 50, back to 25, maybe zero, and now we'll just see in an hour what they'll actually do.
Yeah. And we've also heard stories during these bank failures of some hedge funds and asset managers struggling over this period of time. And I know you're very focused on your own portfolios, the way you run portfolios, on risk management, and you've been a big proponent of using options to express views. So maybe can we talk a bit more about that in terms of, in a period like this, when you get these big moves, how is using options different from taking sort of cash positions or spot positions in markets?
So using options is a bit of a misnomer, because what I really believe in is owning options. There's a difference between being short options and being long options. And it's kind of the directional convexity. You want to be long the convexity, not short the convexity. So when bad things happen to you, you know how much you can lose. You can lose a premium that you put up in this option, whatever it may be. So I had some wrong options. I had options that, this was pre the bank failure, that the Fed would continue to raise rates towards 6%. So I had SOFR, securitized overnight finance futures, put spreads from 5.5 to 6, and I spent some premium on them. Well, when the rates absolutely reversed and dropped by over 100 basis points, and the 2-year rate now is at 80-something basis points lower than it was 2 weeks ago, did I lose money? For sure. I mean, my options were worth less, but I never lost any sleep, because the most I can lose is the amount of premium I put up. And I've heard of people who unfortunately did similar trades, but tried to fund them by selling call options against them. Now, that is a double problem, because as this huge move developed, volatilities skyrocketed. There's this move index, and if you look at the move index, you can see how it jumped up dramatically. So even when your options are in the wrong direction, they tend to not go down as much, because volatility has gone up. Things could happen. Things could just turn around again. I mean, that's what volatility is saying. We just don't know how wide the band of uncertainty ought to be. But for the people who were short options, the ones who were short call options had been destroyed. I mean, they lost an enormous amount of money, not just on the 100 basis points that rates dropped, but also the fact that the volatility skyrocketed. So they didn't just lose the delta that went against them, but to buy back the option, they suddenly had to pay a much higher volatility. And I think that has led to a couple of bankruptcies in the hedge fund industry. Maybe under some other funds, family offices may have had a hard time. I'm not sure.
And so let me ask you this then. I mean, why do people sell options then? Well, given what you've just described, why, it sounds reasonable. You should own options, be long convexity, is right way risk, your downside. That seems like risk management 101. But so why do people sell options?
I think there are a couple of reasons. One is that people think that there are costless trades. Like, I have banks call me and say, oh, if you buy this put, you can fund it by selling this call, and it won't cost you because you're not putting up any money. So people don't like to actually pay for the option, because that's a cash outflow. And they kind of feel like, I don't want to have this cash outflow. I just want to bet on the fact that I believe whatever it is, the euro will go up, or this equities will go down, or interest rates will go higher. The other thing is that, for 10 years, we had really low interest rates, and people got accustomed to earning income by selling options, selling volatility, taking in some premium. Really bad things didn't happen. People have very short memories. Now, I've been trading for, 45 years. So I was there in 1987 when we had the 22% stock market drop in one day. And to me, that's not quite recent, but I remember it. I was sitting on the Bankers Trust trading desk. And, I was even around before that when Volcker raised rates up to 20%. And, I've seen really wild markets that made people lose money by being short volatilities that sometimes they didn't even realize they were selling options, like on spread trades. People often feel that spread trades are just kind of safe. I'm long this and I'm short that. However, they don't often think about how spread trades can just continue to get cheaper. I mean, you're putting them on because you think they're cheap, but there's a reason why they were cheap, which means they can also get cheaper, which you saw during LTCM when people had very large positions off the run bonds versus on the run bonds. And those just got cheaper and cheaper and cheaper because the positions were so large, they had to be unwound. They're already getting unwound. Prices dropped. More people came in to have to unwind their positions. I think a lot of it has to do with trying to earn income by selling volatility and thinking that you can manage the risk intelligently because you have all this math paraphernalia that you built up in terms of models around you, and you say, well, if it moves against me by 2 standard deviations, I will do this or that. But one thing that you can never address in a short options portfolio is lack of liquidity. Like we just saw it in the last 2 weeks in the fixed income markets after the bank failures that we saw, or 2 bank failures. We saw market moves that happened so rapidly that people had virtually no chance to get out anything close to the prices that they thought they were going to get or that they wanted to get based on their models. I'm going to re-hedge my book and I'm going to do this, I'm going to do that. I think that it's virtually impossible to hedge liquidity risk. Whereas it's possible to hedge market risk by being long options. I can buy an option, I know how much I'm going to lose. On the other hand, if it goes against me, I might not be able to sell my long option just because there's no liquidity. So options don't always help you against liquidity risk, but if you're long an option, you always know how much your maximum drawdown is.
And so let me ask you this: do you ever put cash trades on at all, or do you always buy options in your portfolio?
That's a good question. I do put cash trades on, but not very frequently, and mainly in areas where there isn't a good options market. So, for example, Italian bonds, whether you think of them outright or versus a spread to Germany, seem to be a little bit expensive. Right now, they're trading at 180-ish over Germany. Could they go to 220, 250? Yeah, if we have credit concerns and Credit Suisse issues, the spread through Europe, and people start being nervous about credit quality, could those spreads widen out? Yes. Is there an options market for Italian bonds? It's awful, which is not even worth asking for a price. Is there one on the spread between Italian bonds and German bonds? Don't even bother. So, yes, I will do cash trades, but I'm super conservative in the amounts I do. Because I just feel that I just do not want to ever face this problem of illiquidity in a position that's bigger than what I feel comfortable with owning if I have to own it for a really long time.
And then when you are in bulk of your portfolio, when you are long options, do you trade the gamma or not, or do
So
you
my
restrike
view
your
is really
options, or
no.
just how do you manage it?
Yeah, see, my view is no. I think that my strength is thinking about directionality and where things are going to end up. Now, options use underlying the same ideas that we do in the cash market. So carry. Like we think that carry is something that on average works, sometimes better, sometimes worse, different types of periods. And I know you're doing a machine learning tool on when does carry work better. Options take advantage of carry too. So take Brazil, where the interest rates are still significantly higher than in US dollar. So I like to do digital auctions, which are basically an auction that bets on a certain event happening. So I say, I believe that dollar Brazil will be lower 1 year from now. Well, if there were no interest differential, that would be a 50-50 bet, because I take today's dollar whatever, and if it's lower, I can structure a bet that I pay you 50 cents and you pay me $1 if it's lower, and if it's higher, you keep my 50 cents. But given that there is this positive carry, the 1 year bet that dollar Brazil will be lower than it is today only costs 36%. Because the carry is built into the option. So all the kind of things that you do when you run cash portfolios work in the options world also. It's the same space, just translated into a different type of instrument. Now, I think that when you gamma hedge or trade the options portfolio that you own, you're basically only betting on the volatility. What you really want to do then is say, I bought this volatility too cheaply compared to what happened over the period of that option. And so this gamma hedging made me more money than what the option cost me. But that's not where I think the real edge is. I think the real edge is in seeing directionality and not gamma hedging it, not trading it, and just thinking of it as a bet and saying to yourself, I believe whatever, interest rates will be at 6% or higher by December, because 3 months from now, no one will remember the bank failures. And yes, banks will cut back a little on lending, but inflation might still be high. And so by December, or maybe by next March, rates will suddenly end up being slightly higher than people expect. Well, if I do a very tight put spread, that's almost the same as a digital option.
Yeah,
right?
I guess a digital option is like a compressed put or call spread,
Exactly. Yeah. So would I want to trade the gamma of that? No, it's really a question of, is my macro view correct or incorrect? And I like using these digital options or these very tight call or put spreads to see what the market probability is versus what I believe. So back to the idiosyncratic world, I think we're going to see more inflows into different countries around the world for a variety of reasons. Why? Because they have natural resources. And I think for 15 years, we haven't invested in natural resources. Commodity prices will probably be okay for a while longer to attract more investment. We need an awful lot of copper for the whole electrification. Let's get away from carbon-driven, oil and gas, energy, etc. Well, in that world, I think I can look at digital auctions, say on Brazil, and say, if there's capital inflow into Brazil, right now people are nervous about Lula and how he's talking to the central bank, and who knows short term. But over a year, 2 years, I think Brazil will be okay because of natural resource rich exporters building their own brand around the world. I look at Lula's performance 2003 to 2011, the first times he was president. And I think, well, no, he didn't do such a terrible job. He was perceived to be a leftist when he was elected. People were very nervous. Dollar Brazil at that time was 3.5 Brazil to the dollar. When he ended his presidency in 2011, it was 1.95. So the Brazilian real had strengthened quite dramatically, say 30% or so over that period of time. And, that was a period of time where the world was wickedly volatile. We had the great financial crisis right in the middle of it. It wasn't great for commodity prices at that point. Yet, he did something right. So I look at history and I say, well, what does history tell me? How can I learn from history? And history tells me that, Lula is a leftist in terms of caring about the bottom 50% of the country, maybe a little bit more than about the top 50% of the country. However, his policies seem to be working well, attracting capital inflows. So if I do a 2-year forward option, a digital option, saying Brazil will be stronger than 5. Today we're at 5.25. What might that cost? Well, say 4.90. I think that costs about 20%. I haven't priced it. I'm just guessing approximately where it might be. And you'd say, well, that's only 6-7% lower than where we are today. Now, could the dollar in general start dropping over the next 2 years? It easily could, because we have a current account deficit of $1 trillion a year. It's only 3% of GDP, but still, that's a lot of dollars that need to kind of keep coming in to keep the dollar at the same level. We've had huge investments in the US equity market from abroad. So people have made a lot of money because US equity have outperformed many home markets from around the world, and the dollar has gone up. At some point, people want to take profit on those things and bring their money back home. They're underinvested on their home markets. And then you have the other very large people like the SNB, Swiss National Bank, whose portfolio is invested abroad. They've last year started bringing capital back. We saw that they sold foreign securities and brought Swiss francs, and you can see it on their balance sheet. So as that happens, what I do is I look at the probability implied in that auction. Say it's 20% that I have to pay today to get 100% 2 years from now, and it costs at a strike of, say, 4.9. Do I believe it's going to be there or not? And if the market is at 20%, then I believe it's at least a 60, 70% chance that that's going to happen. And that's a really interesting bet. And I wouldn't want to gamma hedge. I'd want to take that directional bet, but in such a manner that my downside is limited. When I'm wrong, I know I will lose a 20% for that.
And the big advantage actually of digital options are that it simplifies things in many ways, that you have this probability, you can map it to your macro view and the probability you assign in your macro scenarios, and you don't get distracted by the Greeks and the maths and all of those things, which can often make you feel like you have more control than you really do about the future. Yeah.
And it kind of puts you on the same plane with the guy who sells you the option, because that person is going to make their money in a very different way from you. So the bank who sells you an option does do their gamma hedging and hopefully ends up losing less than they were paid for the option. And that's their profit. So they hope to sell you this option for slightly too much. But in a sense, you don't really care You just compare what is that price, what is that probability compared to the probability you believe it ought to have.
Yeah,
And
so
that,
what the trader cares about is the volatility, and they want to get paid for that. And what you care about is the direction, not the volatility in some ways.
right, you care about the probability embedded in that volatility. And if the volatility
the
really
path.
went up a lot,
Yeah.
then it might change the price of digital, but it's not as significant as an outright call or put option because you're giving away some of the tail. Like you're going to make 100 if you're right. Now like dollar Brazil ends up at 489, so the 490 strike made you money, but you don't make any more if it ends up at 400.
Yeah. So your payout's fixed then, so right. you don't have that unlimited.
Right. You basically gave back something to the person who sold you the option by doing the digital. You don't own that tail. And that kind of helps with making those options slightly cheaper in a certain sense.
Now, you mentioned carry earlier, and, carry for the benefit of our listeners who aren't as familiar with this. So this is essentially when you buy high interest rate markets and sell low interest rate markets or fund it with low interest rate markets. So you earn the interest rate differential. And your hope is that the spot market doesn't move in a way to offset that interest rate gain. It's popular in FX markets. So I wanted to ask you, Jim, do you think one can systematically trade that in a portfolio, or would you instead just pick one carry trade and just make a bet on that?
So once upon a time, I used to be one of the largest carry portfolio holders in the world. I worked for a bank, the Bankers Trust. And I think we were the first ones who ran carry as a portfolio. Now, in those days, it was slightly easier than today because we didn't have the euro yet. And we still had all these individual European currencies trading at different interest rates, yet somehow linked by bands, plus or minus 2.25% bands that central banks were holding things in. Well, of course, there were also lots of currencies outside of the European monetary system. There was, Sweden wasn't part of it, or neither was Mexico. And, you could find things all around the world to include in that portfolio. I think that the carry portfolio went away a little bit during 2010. It didn't perform very well during GFC. People got burned. And interest differentials really narrowed. Like you didn't have these really high Italian rates versus German rates, etc. However, now that the world is becoming, again, multipolar, and we're starting to see interest rates very different between different countries. Like, why are interest rates in Asian currencies so low and Latin American currencies are so high? There's all kinds of long, short portfolios that you can look at and hold. And if you look at carry today, is analyzed much more intelligently than what we did 40 years ago. We looked at high carry portfolios, and the alpha came from not getting devalued on, from being smart enough to avoid the devaluation that you knew was going to happen eventually in Italy, but not while you were on the place. So we did a really nice job when I was running those portfolios to never get devalued on. The beta came from the interest differential. So we still have a beta today, which is a classic carry portfolio, but it's become much smarter in that you have other approaches. So you now have a deep options market. So you can do carry compared to what would an option cost you. And you have volatility, what we call that is volatility adjusted carry, where you can see that a certain currency pays you a lot of carry, but the volatility is really low. So you could buy an at the money forward versus at the money spot option spread.
Which is what we talked about with dollar Brazil example earlier as well.
You could do that.
Yeah.
You could do it in India. Because the volatility in Brazil is really high, the volatility in India is really low. You could do it there. The other way to think about it today is that capital flows a better measured, more analyzed. So one way to look at the carry portfolio is the equity adjusted carry portfolio. Which equity markets have outperformed over the last, say, 30 days, and which ones have underperformed? And if the high carry currency is also in an outperforming equity market, it gets a check mark and you belong in it. Or if the low carry, low interest currency is in a underperforming equity market, it gets a check mark. But if it's not confirmed by the equity market, you just don't do it. So I think you could run those kind of portfolios today. You have to be more careful than I think in the late 80s. But it's totally within reason running them, number one. And number two, I think it comes back to learning. Like the world is incredibly large. Every day we have thousands of data points come at us. Whether it's individual prices or it's political news or it's, equity, individual equities, equity markets, etc. And to cut through the noise and find the signal, you need ways to think about the world. And carry gives you the way to think about the world. So if you look at the equity adjusted carry portfolio over the last 30 days is long Mexican pesos. Well, that tells me I should put Mexico right up there in my basket of, you have to think about Mexico.
Yeah.
It's important not to not think about it. So when news comes out about Mexico, you want to make sure that you kind of follow it. You want to look at it because somebody out there is long Mexico because it is a high carry, positive, outperforming equity market versus the median, etc. So I think, learning is something super important, and using these kind of methodologies to cut through the noise to figure out what you want to learn about is an important part of macro. I think too many people do not spend enough time to learn about the markets and to explore the market. So a long time ago, if you look at Wikipedia in 1960, there was this thing that was called the secretary problem. And today we wouldn't call it that. We'd call it my personal assistant problem or my assistant problem. And the question was, you received 100 resumes and you're supposed to hire one person. You're trying to hire the best person you can. The rule is you can interview number one. If you don't hire them, they'll go find another job. They're gone. What is the approach that you should take to find, and you're not just randomly picking one out of 100? So the approach is, if you play with this mathematically, you can just say you get 3 resumes. Well, what would you do? How can you do better than 1/3 chance of picking the best one? Well, you take the first resume and you learn from it. You kind of go, well, this person has these skills, and now I have 2 more resumes. You don't hire the first person, but you hire the next one who is better. Or you hire the last one. So, if you score them 1, 2, and 3, and you do that, and you kind of pretend that, well, you pick 2 first, and you use that to explore, and then you exploited either the third or the first resume, but you hired whoever was better. It turns out that 50% of the time you'll hire the best person rather than 1/3 of the time. So the rule is you should spend about 37% of your time exploring. And to me, that's very the same. We don't look at resume, but the hours we spend don't come back. They're like the hour where I didn't hire somebody. That was the first resume. I didn't hire that person. That person went away and got another job. I have an hour coming in later from 2 to 3. That hour, once it's gone, has gone someplace else. And so I think of my world as split into hours. And I should use 37, 1/3 of my time exploring, just thinking, reading new books, reading articles where I just might stumble into something interesting that makes me think a new thought. I should spend 2/3 of my time exploiting what I've learned, looking at the screens, thinking about positions I already have, new positions I might want to put on, where should the strikes be, what should the maturities be? I mean, one of the reasons options pay you better is that you have to be more correct because they have a maturity, right? I mean, you could just have a cash position in something and say, well, I don't care how long it takes. I am 100% convinced it'll be higher. Well, with options, you can't do that. You have to say, well, it'll be higher in 6 months or in 3 months or in 1 year. So, options take a little bit more decision-making than doing a cash trade, but that's why they also give you all these other benefits. Pay you better, they're convex. You can only use your options premium, but on average, I mean, when we've done it, we looked at our high conviction bets over the last 4 years, kept track of them in 2019 from then on. And on average, we made 150% on the bets that were correct, and we lost 82% on the ones that were wrong. Because at some point we realized this was just wrong, and we didn't actually hold it till it went to zero. We just said, might as well recoup 18% of this options premium. I think that having this approach of using 1/3 of your time to learn and explore, and 2/3 of your time to structure new options bet based on what you learn and explore is super important. And that many of the macro traders I know are just too close to the streams. They trade too many times a year without having learned something new. And I think it's more important to actually constantly be looking for ways to cut through the noise and find the signal. And one of the important ways is reading constantly, asking your friends for input. Like if you have a decent network around the world, you will have people to talk to about, interest rates in Turkey or things that you hadn't thought about before.
I like that a lot, actually. So 1/3 exploring and then 2/3 exploiting the opportunities that you've unfolded.
Yeah, I think that's a good rule of thumb.
Yeah. And at the moment, what are your favorite trades you have on at the moment?
I don't have many. I have some dollar Brazil.
Yeah.
But I didn't do a great job in that. I didn't do long enough maturity options. So I had some maturities already, some in the money, some not. I should have, right after the election, done them way longer. I thought it would take 3-4 months and people would kind of get accustomed to moolah and we would see capital inflows. I should have just done 1 year. In general, I do 1 year options. And historically, we've sold them after about 110 days. So that's worked out kind of as a rule of thumb. But when we buy shorter options than that, they haven't worked as well. So we're trying to go longer so they don't mature on us before our idea actually comes to fruition. I don't have that many other things. I have the interest rate bets where I don't think that the Fed is actually going to be cutting rates as much as the market assumes. Right now, if you look at the Bloomberg function WIRP, it shows you that the market is expecting the Fed to cut rates starting around June. From June on, there'll be more and more cuts all the way down through December. And I just don't see inflation dropping rapidly enough for that to happen. I think the Fed will use the balance sheet to address liquidity, not interest rates. We'll see in half an hour what the Fed actually does today. I think.
And I recall from our earlier conversations and just our regular calls that we have that you have been a proponent of crypto as an asset class. obviously we've seen lots of turmoil in crypto at various points. This year, actually, crypto is performing quite well. I mean, do you still invest in crypto? I mean, have you have things questioned your faith in it or not?
Yeah, I mean, all of the above. I invested in 2019, and Bitcoin was at 8,450. As Bitcoin went higher, I switched around, I added some altcoins, etc. I had a terrible 22 in crypto because Bitcoin dropped 60% and altcoins dropped 90%. And this year I'm having an okay year. I just don't manage it actively. It's just a small part that I think either goes to zero or it's going to be worth a lot more. Have I lost a little bit of faith in that? I would have expected to see more use cases by now. I mean, 2019 was about 4 years ago or so when I first time put some money into crypto. And, 4 years later, I'm surprised how few new businesses really exist because of crypto. I think, it's a little bit like this new AI stuff. People get very, very excited when new things come out. Too excited. They probably overpay, but then they're not excited enough about what happened over 10, 20, 30 years. So I think, people got super excited about the internet in 1999 and 1998. The prices skyrocket for companies that all go bankrupt, toys.com, etc. But, now everybody carries a computer in their pocket, and without the internet and the way the internet has changed, we wouldn't have Uber, we wouldn't have Airbnb, we wouldn't have all these businesses that, we didn't even imagine 20 years ago. And I think with AI, for example, right now, we're in that kind of phase where everybody is super excited, and probably in the PE world, people are overpaying for AI companies, and, it's a good time for them. But, we'll have that same kind of reaction when you find out that it takes time. Yeah. it'll be an overreaction in the short run, underreaction for the impact it's going to have in the long run. I think the same with crypto probably, unless crypto ends up just going to zero, which is possible.
Yeah.
But that's why, you shouldn't really have too strong an opinion about it. It's a new technology. It could do really well, but also terribly. I mean, I have friends in emerging markets, obviously, because I love thinking about the world. And when I talk to them, there are more people in Brazil who seem to have a crypto account than an equity. So, that says something about it. For some people, it's very useful.
Yeah, and I think also there's a generational element to it as well. I find younger people are, have a lot of exposure to crypto, and they're quite, comfortable in that world more so than older demographics. Now, I did want to ask you before we wrap up our conversation about any good books that you read of late. I know you're a big reader. It's part of your exploration, in finance, outside of finance. So are there any really good books that you've read of late? Yeah,
I'm just in the middle of something called the Socratic Method, which is really enjoyable, written by the dean of the law school of the University of Texas. And, I feel that we are all too certain about our opinions, and we should always look for disconfirming evidence. So when I think, I really like Brazil, what I shouldn't look for is evidence why Brazil is great, but what are all the things that could go wrong? And I think the Socratic Method is all about questioning your assumptions. According to the Platonic dialogues about Socrates, it was always done by a question. Is this really what you believe in? And how does it work if you think of it in a different setting? Would you still agree with the statement you just made, etc.? And I think for all of us to really focus on thinking about learning and how to do a better job analyzing information is what will make us better at investing in general, whether it's macro or just, domestic portfolio. We want to be able to look back and question the assumption that we've made when we've made investments and trades. And this book on the Socratic method, just kind of a reminder of how to do that. And then if you want an interesting book on AI, there was one written by a guy named Christian called The Alignment Problem.
Yeah. I think
that's
I've heard
definitely
that.
worth reading, especially chapters like 3 through 6, all about learning. Like, how can we teach computers to learn? But it's really also about how do we learn. And I think readers listening will enjoy both those books.
Okay, that's great. I'll add those books in the show notes as well. And then how can people follow you? What's the best way for people to follow your opinions and connect with you?
Just reach out to my email, jleitner@falconmgt.com. I tend to answer my emails. Sometimes I overlook one. I get like 2,000 a day. I tend to sometimes not see them, or I'm on LinkedIn. But otherwise, I don't really post anything. No. But I'm always happy to try to communicate and make new friends.
Great. No, that's excellent. So with that, thanks a lot. As always, I learned a lot through our conversations, and good luck with all your trading, for this year.
And good luck with Macro Hive. Love what you guys are doing. Want to be as helpful as I can.
Great. Thank you.
You take care.
You too.
Bye.
Bye. Okay, Jim, that was really good. Hope you enjoyed that.
Yeah, it was fine. It was fun. I mean, I enjoyed it.
I liked it a lot. Yeah.
You think so?
Okay. Yeah. Because we're from very sort of big picture, multipolar stuff down to micro, how to, trade portfolios. I think, I enjoyed that, and I think listeners like that as well. It's like a sweeping view of everything.
I had not prepared, but I thought about, the multi-Hall paradox. We'll talk about that a little bit more. It's about learning.
Okay.
Because, the multi-Hall with the 3 doors, you open.
Oh, yeah.
He opens the door. Should you switch or not switch?
Yeah.
And basically, to me, that's, just a story about the game master in a kind of convoluted way, passing on information to you. By opening a certain door, he's saying, oh, the prize was not behind here. She knows where the prize is hidden.
Yeah.
They're not going to randomly open the door. They're opening a certain door. So that's why you should switch. And what does that mean in trading? What it means is that you need to figure out who are the game masters in the world and listen to them, because they are passing along information to you. So 2003, 2004, the S&P came out, and I just started listening to them, and it turned into a huge Euro-Swiss up trade because they came in and intervened. And nobody knew they were going, but they kept saying, there are other methods we can use. And no one knew, to me, it was obvious, what other method is it?
Yeah. You're using interest rates already.
Today, we should be listening to Yellen. I mean, she is the game method. She ran the Fed. She was head of the Council of Economic Advisors. And if you don't listen to Yellen, then you're just basically walking away from something that you shouldn't be listening to. So I was going to talk about that, but
maybe the next one. Yeah, but I do like this idea of kind of meta learning. Learning how to learn. What you touched on in those books that you're reading. This whole thing of how do you learn? How do you improve your learning? How do you uncover knowledge? What's the process and all of these sorts of things? I think it's really, really wise to remember that or to learn that.
Yeah, I think most macro guys don't. Honestly.
Correct.
I think that's why so many of them end up doing a mediocre job, because you don't learn anything new. Learn certain things. But the world changes, and yes, knowledge is cumulative. I know carry trading for 40 years ago. It changed dramatically in between.
Yeah.
And now it's very different. And, I'm learning, again, working with Ben. Reading through his stuff and thinking about it. Anyway, Yeah, I think learning about learning is something that we could do an hour on something.
Yeah, exactly. Yeah. And the reason I mentioned the gamma thing is I speak to so many clients, like hedge fund clients, who kind of, even though they're directional guys, they trade the gamma. And I think part of the reason is because they come from options market making desks from before. It's like this habit they have where they can't kind of help it almost. They want to kind of always be doing something.
Right.
We almost kind of say, look, you don't need to, but it's almost like a training they have, and it's hard to unlearn that. Because market making to prop trading, or directional, it's a different job. I mean, it's
you have to be directional more correct than unless you are trading volatility. You're saying, I think volatility is way too low here, and I bought all these options, and I'm going to gamma trade them. Okay, that's a different story. But then you're betting on this thing called volatility. You're not betting on dollar Brazil being lower.
Yeah.
Super. That was fun. I mean, I hope you guys, I hope people like it.
Yeah, they will. I'm sure they will. We'll release it this Friday. It takes a day or so just to turn it around, and then we'll push it out on social media and everything. I'm sure it'll do well.
Oh, the other thing I was going to talk about, which I also didn't get to, was correlation trading.
Okay.
Because again, it's like an option. You only go to 100 or minus 100.
Yeah.
So if you're selling correlation. And right now, correlations are all sky high because volatility is high, correlations are higher, blah, blah, blah. So if you look at history, we're at fantastic levels to sell correlation. You can just sell correlation swaps.
Yeah.
And you know how much the worst thing they can happen is they become 100% correlated. Well, highly unlikely. It hasn't happened in history yet. But it can't go to 101, right?
Correct. It's
like owning an option in a mean reverting world.
Yeah. No, that's good.
That's an interesting
something to think about. Yeah. Add that to the list. And we'll talk tomorrow, by the way. We have a call.
We have our little thing to talk about the carry
machine learning stuff. I think
I want to bring that up just so that people who listen kind of know that you guys are
doing I appreciate that.
Edgy things.
Exactly. No, that's good.
Good luck.
Okay then. Well, good luck with Fed. Okay then. See you then.
We'll see what happens. Bye, buddy.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.